Alrighty guys, welcome to the 6th episode of the FVT Trading Bootcamp, where I'm going to take you from day 1 to day 20, all the basics, all the complex stuff, but I'm going to simplify it. Now, in today's one, we're going to talk about fair value gaps, and this is probably going to be a long one. I'm just rolling off the top of my head, right? And I want to talk about fair value gaps, and I want to start off with the higher time frame. A lot of people are going to ask me this, and I'm going to answer at the start of the video. I typically only use the 15-minute, the 5-minute, and the 1-minute chart, typically. Now, that means that 95% of the time, that will be enough. You might ask why I use higher time frame gaps. Well, there's a reason. If the market, write this down, if the market has moved very aggressively, like this, and then you come to your session, say you trade down here, right? This is the end of day session. So that's when you trade. Say you trade the PM session here. Now, if the market's moved very aggressively in one direction, down or up, I will then go to a higher time frame like a 1 hour or 4 hour or daily. I couldn't care though on a normal day like today for the higher time frame yet, especially if there's lower time frame gaps around. So I want you to write something down, and I'm going to explain what a fair value gap is first for those that don't know what it is, and then we'll get into how to use these fair value gaps. Now, a fair value gap is essentially just a gap between 3 candles, right? So for example, candle number 1, candle number 2, candle number 3. There is a gap between this candle's high, see this candle's high, and this candle's low. That is a space, and we call that a fair value gap. Now, why is it called a fair value gap? Well, the market likes to seek fair value, and it comes back to the point I mentioned in the market structure lesson. I told you guys that the market can't keep going up forever. It can't go like that, and it can't go like that. It has to seek fair value, and it does so by pulling back. These are what are called fair value gaps, and price uses these. Just write this down. Price uses fair value gaps as support or resistance, and we're going to see that in a while. So bullish fair value gaps, I'm going to mark out all the bullish fair value gaps, which just means moving up. Bullish means moving up. All the bullish fair value gaps moving up, I'm going to mark them all out, right? From the bottom of this swing, again, what's this called? What's this called? It's called a swing low. Beautiful. Now I'm going to mark out all the fair value gaps here. I'm going to mark out this fair value gap here. And you're going to see it's a 3 candle formation or pattern, you could call it. But I want you to really be able to identify these. You have to, right? If you're trading my concepts, you've got to be able to identify what a fair value gap is. And if you're not sure, again, hop in the Discord, ask the community. People will help you out. There's plenty of experienced people there. It's completely fine. So these are all fair value gaps, right? We'll mark out, these ones here. Just so you guys can see, there's so many fair value gaps, so many. But what I want you to point your attention to while we're first here in this video is notice how the market uses these as support. And what do I mean by support? Well, in a trending market, if we pull back, the market's going to find support and bounce from somewhere So essentially, what this means is this. Sometimes we revisit these fair value gaps and we find support here, we bounce. Other times we don't revisit them. So I want you to write that down. Often we find support here, but if we don't revisit them, write this down. If we don't revisit them, it means the market is very bullish or very trending in that direction. You can see that, right? We don't revisit, we're very bullish. We bounce, we find support. We bounce, we find support. Often, if there's 2, and this is something for your notes too, if there's 2 fair value gaps in a leg, right? And we'll talk more about this later, but you grab what's called a Fibonacci tool. You go from the bottom to the top, like that. And often, you want the fair value gaps, or when the market pulls back, you ideally want it to pull back to one that's beneath the first one. Because if price just does this, all it means, if price doesn't return to this bottom one, it just means the market's very bullish. That's all it means, right? And you can see that here, right? So if we remove all these, look, this here is another swing. We'll get more into this a bit later on. Notice here the market comes beneath this halfway point. It pulls back. It seeks fair value. And then after doing so, it reacts from this fair value gap. Again, we push up. It doesn't return to this one. Must mean it's very bullish. It returns to this one and pushes out of it. Means we're quite bullish. And these are bullish fair value gaps. So again, the market finds support and resistance at these fair value gaps. Because a lot of people are going to say, well, how do you use them, Ruben? What do you do? Use them as support and resistance. It's as simple as I can put it. And if it doesn't return to a fair value gap and it has impulse out of an area, say here, for example, right? Look, say here, the market's printing live, by the way. This is live. We've got a fair value gap here. I'm going to mark that out. We've also got a fair value gap here. Now you're going to say, well, Ruben, why didn't we return to this fair value gap? Well, we might be very bullish. And you can see we're very bullish. The market's, trending up. You can see that. Ever since Asian session, we've come down. Look, we came into this fair value gap, but we failed to come into that one. Same thing here. What happened, guys? We have one fair value gap here. We've got another fair value gap here. Price only came into the top one. So this is a repeatable pattern thing. You're looking for these repeatable patterns to happen in the market. It's very, very important. And this is just what it means, right? You can see how we're bouncing from that area. Now, you're going to see this happen on all time frames. So I could go to any time frame chart. I could go to a daily chart, for example, if you like that. And I can show you exactly the same thing happening. Exactly the same thing happening. Look. And we'll talk more about different PD rays later. That's your bullish fair value gap. Bullish fair value gap, right? There's another one right here. And you can see how price bounces. It occurs, right? It occurs in all time frames. So that is what a bullish fair value gap is. And then later on, we'll talk about how to apply this, go a little bit, in a bit more depth and detail. Let's talk about bearish fair value gaps now. Bearish, right? We'll talk about the opposite. So in a downtrending move, there's going to be bearish fair value gaps. And it's the same thing. It's a 3-candle pattern like this. These are bearish fair value gaps. And there's plenty of videos online, so I don't want to spend too much time on the complete basics. But these are bearish fair value gaps, all these. And there's more, right? There's another one over here. There's another one over here. There's heaps. And this is what I do. Like when I first started learning fair value gaps, I marked out all the fair value gaps like this. And then I noticed that some were respected and some were not respected, which is an important distinction to make. But you can see, right, how price trades into that fair value gap and it sells off. It trades into this fair value gap and it sells off. The bigger ones are more important. The smaller ones are less important. That is a part for your notes too. All right, so I'm going to drop little gems as I go through. I'm just brain dumping here for you guys as a part of this boot camp. Now that you understand what a bearish gap is and a bullish gap is, you can see that the market, obviously when we're trending down, uses these gaps as resistance, 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 and at some point it flips. And this will be probably the next lesson when we talk about inversion fair value gaps. But I'm going to linger on this a little bit here, just a little bit. Now, an inversion fair value gap is something like this. So a bearish fair value gap, normally we trade into it, and what price is meant to do is go lower. But when price trades into it, but it goes higher instead and it closes above, that is now called an inverse fair value gap. And that is an indication of a change in sentiment or a change in the state of delivery. You might have heard that term before. So a change in the state of delivery from moving down, you can see it, right, to moving up. And this is it's like a signal, right? You don't need indicators, right? This is a signal. This is your indicator that the market could be switching. And if it occurs on a 15-minute chart or a 5-minute chart, it's better than if it occurs on a 1-minute chart. It means more. It holds more weight, right? And we'll talk more about that later on, but that is what an inverse fair value gap is. Now, let's go into the charts and let's just talk a bit more about fair value gaps and how to apply them. But I want to give you guys some annotations and some things to study, right? And we'll talk about what's happening here with price and what I mentioned to the community as well. Now, here we go. Let's say the market does this. And we've talked before about the market. So that's what the market looks like. We talked before about when the price sweeps a low or a high. We talked about this, liquidity. When we sweep liquidity, we can always reverse or reprice. Now, one thing you want to look for is you want to see price sweep a low or a high, and you want to see it tap into a 15-minute fair value gap. That is what I call a higher time frame fair value gap. So write that down. Higher time frame fair value gap is a 15-minute fair value gap. And you can see we sweep the low, we react from there. Same thing can happen. Again, I'll show you an example on the charts here. Look, we sweep a low, and what does price react from? A fair value gap. What time frame? 15 minute. So you're going to see either a combination of sweeping and fair value gap, or you're going to see just a sweep or just a fair value gap. They're all good, but what I'm going to say is this: the more things you have combined, the better. So if you can have a sweep of liquidity or multiple sweeps and a reaction from a higher time frame fair value gap, it's better than just one or the other. That's just how it goes. More confirmations, better quality of trades, right? And you're going to see this in the bullish and bearish example. So I'll show you here, right? Have a look. This FVG here, what we can see is this. And by the way, each of these candlesticks is like a high. So I'll show you on the lower time frame. We come up, we sweep this little high here, look. And if I go back to replay mode, let me just take it back here. And let me go back to say like a 5-minute chart. And then let's go back to like a 1-minute chart, just so you can see what this looks like, right? That is a sweep, right? Now, the sweep, you might ask me, like, does it have to be in a 1 minute or 5 minute? Wait for price to engage the fair value gap first, would be my thing. And then when it engages that fair value gap, then look to see if there's a sweep. That makes it simple. Wait for it to engage the POI, which is the fair value gap. Then if there's a sweep, fantastic. And from there, we can move on. So you can see we sweep that high, and then what does price do? We reverse. We fail to sweep another high. That's a weakness in market structure, right? We have wicks. We talked about that. We talked about wicks in the very first lesson, or second lesson, I think it was. Wicks being rejection points, big down close candles being a good thing, right? And here's another point I want to mark or make, for you guys too. You're going to see way more fair value gaps respected on the 15-minute chart compared to the 1-minute chart. So a lot of people, they're on the 1-minute chart, right? For example, let me just show you guys on the 1-minute chart. They're on a 1-minute chart and they go, well, wait a sec, Ruben. They go, well, wait a sec, Ruben. The market, look, the market's moving up, but wait a sec, Ruben, we inverted this fair value gap. See how we closed below that bullish gap? They go, oh, the market must be going down. No. Because the higher time frame holds more weight. So you're going to see a lot of 1-minute PDRAs disrespected. This is normal. I don't care what other people promote about everything being perfect. It's not always perfect. That's the reality. That is the key. Probability over perfection. Probability over perfection is always going to trump perfection. Believe me, right? I used to think I had to be perfect and have all this perfect stuff going on. It's not the case, right? So you can see sometimes the market still trends up, but we disrespect bullish fair value gaps. On the 1 minute, on the higher time frame, you probably won't see that as much. You're going to see it respecting more, right? You can look at this, right? Look. When we respect bullish fair value gaps, we move higher. We respect bullish fair value gaps, we move higher. Very rarely, right, do we disrespect a fair value gap and then still move in the same direction. Like here, I'll show you an example. This is a bit more advanced. You might say, well, Ruben, we inverted, we'll talk about this next lesson, we inverted this fair value gap here. But guess what? We inverted this one, but isn't there another fair value gap resting below? Yes. So if there's another gap resting below, it's reasonable that the market can still move higher. If price were to close below this one and below this one, then I would say that probably it's going to go lower, right? So that's a little trick for you. But you can see how the market finds support. And you're going to see this in all time frames. Even on the 1-minute chart, you'll see it. But all I'm trying to say here, don't get caught up in the 1-minute chart. Don't get lost in the 1-minute chart thinking that everything is perfect, right? Sometimes, yes, it's perfect. Sometimes it's not. Like here's an example from the Asian session, for example. And we'll get into a couple different sessions too. You can see in this case, yes, we perfectly respect it, right? Fair enough. Let's go back into maybe, New York session, right? Look at this. The market is trending down. Look, trending down, 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 down. There is a bearish fair value gap here, but we close above it. That is not a signal to go long, right? And this is a big thing I want to just reinforce and point out, right? We'll talk more about it as we go on, and I'll have a few videos of me, executing live and talking through the markets live, etc. But bearish gaps can still get ran through and price can still move lower because, again, what's the overlying market structure, the underlying, we form a swing high here and this swing high is lower. That's bearish. So don't worry about perfection. You won't get far with perfection, but you will get far with probability. If you think about probability rather than perfection, you're going to see great success. If you don't, then you're going to be very troubled and you're going to struggle when the market doesn't perfectly respect a PDRA. All right, so say for example here, look, you can see there is a fair value gap here that is holding the market as support. You can see that. And this is a fair value gap on the 1 minute chart, but notice how this fair value gap that's acting as support is also on the 15-minute chart too. So sometimes what I like to do is I start off with a higher time frame like this, right? And then I drop down to the lower time frame to see if I can narrow down that range. And you can see I can narrow down that range. I can narrow it down to this. Support, support, support. What has price done? Let's link all these concepts together as we kind of progressively go through. The market has swept liquidity. Let's talk about candlestick patterns. When we sweep that low, do we sweep the low and keep going, or do we sweep the low and reject? We reject. Fair enough, right? So this is the key. This is the key to fair value gaps, right? Support and resistance, and it can use the same fair value gap multiple times. A lot of people ask me that too. Like, can it use the same fair value gap once, twice? Yeah. That just means it's very strong. So that's very strong to move up. If we were to invert this, then it's very strong to move down. That's pretty much all it is. So you can see again, look, even on the 1 minute chart here, look, I'll show you again another example. There's a gap in price here. We use it a couple of times. It's very strong. If we go back here onto the 15-minute chart, just to show you guys what it looks like. Again, it's a fractal concept. Look, notice how that's the 1 minute fair value gap, but the whole fair value gap is like this on the 15-minute chart. Right, so you got that. But I like to narrow it down so that I don't have to have a big box, because I don't like having too much on my chart. It's just too conflicting, too much going on. But that's how I use fair value gaps. Another thing you can do for those that are still here, and we need to go to the higher time frame for this. If you ever have a big fair value gap, let's say a 15-minute or a 1 hour or whatever it is, get the fair value gap, and this is where we're going to introduce the Fibonacci. Go here, right? Click on that, click this arrow, click Fibonacci, and you're going to measure out the quadrants, right? So I'm just going to measure out like this, click once, and then drag like that. Now, if you want my settings, here's my settings. All you need is this. That's all you need. You can also add 0.25 and 0.75. These are the quadrants. So I'm breaking up this fair value gap into quadrants. What does that tell me? And ICT's talked about this heaps. If the market stays roughly around, the halfway point and it pushes higher, that means we're very bullish. If the market stays up here and pushes higher, extremely bullish. If the market comes down here and then reacts, somewhat bullish. If the market comes down like this, well, we just need to mark out this fair value gap and do exactly the same thing, right? And we can do the same thing here, right? Look, this fair value gap, we'll grab the Fibonacci from the high of this candle to the low of that candle. Price taps on the halfway point and pushes up. Again, it's not always going to be that perfect. Please don't think that you're going to see that perfect reaction all the time. I'm sick of people, I'm not naming names, but I'm sick of people promoting the precision elements that aren't always there. Sometimes they are, yes. But again, probability over perfection, please. Please, please, please. Because again, it's not always going to be that perfect. Sometimes it is, it's fantastic, but it's not always the case, right? And so you can see what's happening here. Again, we can mark out this fair value gap like that, right? And we can grab our Fibonacci, go like this. And you can see here, what did price do? We didn't even come to the halfway point. It's very, very, very bullish. And you can see what the market's done, right? And the same could be said with bearish fair value gaps. So you can do the same thing on the downside. Look, in any trend, right? It doesn't really matter. So you grab this, this bearish gap right here, like this. Mark this out, high to low, same thing. We kind of come to about the halfway point, pretty bearish. This one here, mark this out. This candle's low, this candle's high. That's the bearish fair value gap. Mark this out, boom, boom. We don't even come to 0.25. So you can tell, right? You can tell how bearish or bullish we are. Look at this. This fair value gap here, we just mohawk. That's still acceptable. It's still okay because we still close. But notice how when the price doesn't react from here and go down and it spends a lot of time, it just mucks around for a long time. Whereas when the market, look, here's another example. When the market closes within or it closes very low and projects lower, it moves very aggressively. So that's what I'll leave you guys with. Bit of a longer lesson here, but that's how I use fair value gaps. You know, support and resistance. You know, I want to see the market find support at fair value gaps when we're trending, pulling back, finding support. It's a basic concept, but you need to understand this. Anyway, join the Discord. That's the end of this lesson. Any questions, post them there. And again, guys, study. We'll see you next time. Peace.